Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to do a deep dive on that US inflation print that came out last week. We'll also have a look at consumer sentiment and inflation expectations. We'll do a preview for European growth. And finally, we'll have a look at that South African inflation print too. We're going to start off with some good news with regards to a trade deal. There's some press releases that came out on Sunday, and it looks like China and the US are closer to putting a deal together. Xi and Trump are due to meet on Thursday. The market response to the news on Sunday has been very good. Already we've seen futures up quite strongly in the US and pretty much across the globe as well. In broad outline, it looks like China is going to review its rare earth policy and pause it for a year, and in return, US tariffs will be reduced. That looks like the broad outline. Let's see how it settles later on this week, but in the interim, it's quite a positive development with regards to global markets. Okay, onto that inflation print that came out last week. US inflation ticked up to 3%. That was a bit below the consensus forecast of 3.1%. And as a result, it was very well received, both in terms of the market response, which was quite positive, and the financial press, which wrote in glowing terms about the US inflation print. But if we scratch a little, I think there was little reason to be very optimistic with regards to the print. As a starting point, US inflation still increased. It might have increased by less than expected, but it increased nonetheless. And month-on-month inflation was at 0.3%, so annualized running at about 3.5%. If we look at the inflation for trajectory of the next couple of months, even under the optimistic scenario that month-on-month inflation drops to 0.2% from the current 0.3%, even under that scenario, US inflation remains at and around 3% for the next few months. In our view, it's more likely to be above that. So it would be quite difficult for US inflation to get to 2% anytime soon. We need month-on-month inflation to be at 0.1% to get US inflation down to 2% by January next year. And this just highlights the difficult situation that the Fed is facing. Given the latest inflation prints and the most reasonable trajectory, it looks like inflation in the US is going to be 3% or above for the next few months at least. If we dig a little bit further into those numbers, we can see that shelter inflation continues to decline, and that's a welcome development, sitting at about 3.5%, and shelter inflation was the key issue last time around. But inflation ex-shelter just continues to increase, and now sitting at 2.7%. So even if shelter inflation was sitting at 2%, if inflation ex-shelter is at 2.7%, the aggregate basket is going to be well above 2%. And that is the difficult situation that the Fed faces. If we look at core inflation, and there are a couple of ways of looking at core inflation. There's the headline core print, but also we can remove prices which are more variable and get estimates of core sticky inflation. We can get core sticky services inflation. There are a couple of ways of doing it, but whichever way you do it, core sticky inflation is looking like it's sitting at about 3% at the moment, with little sign of it coming down. And that is going to be quite concerning for the Fed. This indicates or reaffirms that inflation in the US is likely to be at and around 3% for the foreseeable future. Even so, the Fed is expected to cut this week. I've got a meeting on Wednesday, and the market is pricing in a 25 bip cut with 100% certainty, followed by another cut in December. And then next year, another cut is expected by March and another one by July. While a cut this week does seem likely, given the guidance from the Fed, it does seem that the market is quite optimistic with regards to the interest rate outlook over the coming year, given that there's no sign inflation is going back to 2% anytime soon. And if anything, there's a risk that the Fed cuts by less than the market currently expects over the coming 12 months. Even so, if we take a step back and have a look at what's currently expected for the ECB, the BOJ, the Fed, and the BOE over the coming year or so, we can see that the ECB is expected to keep rates flat. Inflation is at about 2%. There's little scope for them to cut by much more, given where we are at the moment. So ECB rates remain flat, the Fed cuts, and the BOJ hikes. So in effect, over the coming year, we're likely to see a convergence of interest rates to the extent that interest rates are going to be the most similar across those three that we've seen in about 3 years or so. Why is that occurring? Well, that's occurring because inflation expectations have converged across the Japanese market, the European market, and the US market too. Inflation expectations are the closest that they've been in several years. And that's interesting because despite what we've seen over the short term with regards to US inflation, the fact that it's increased to 3%, it looks like it's not coming down to 2% anytime soon. None of that has really affected longer term inflation expectations, which are pretty steady at just around about 2%. So we've got this convergence of inflation expectations across the globe despite current volatility in inflation, and that's led to an expectation of a convergence of interest rates across the globe. Let's see if it pans out. There is some risk here given the volatility of inflation, but nonetheless, I think that's the broad theme that's currently playing out through interest rate expectations in markets across the globe. Looking at US sentiments, consumer sentiment declined again based on the University of Michigan survey. It's not just that sentiment declined, it's that US consumer inflation expectations remain pretty elevated, expecting inflation next year of about 4.5%. And again, this is going to be a concern for the Fed. The latest data suggests that inflation is not declining and inflation expectations are pretty elevated. And that's an environment which is typically quite uncomfortable for a central bank. And it just reaffirms the idea that they're less likely to cut by 4 times over the coming year than the market is currently pricing in. And finally, switching to Europe, we've seen an increase in French manufacturing confidence. And the reason that's significant is that this series tends to correlate with manufacturing PMIs, which in turn correlate with GDP. And it suggests that the current growth expectations, which are pretty modest for Europe at large, are probably a little low. And we expect that there is some scope for an upside surprise with regards to European growth when those numbers come out, which will be in the beginning of next year or so. So a bit of good news to wait for on the European front. And finally, on South Africa, South African inflation came out last week. It ticked up. Inflation sitting at 3.4%, so mildly above the SARB's new target. The issue is over the next few months, simply due to base effects, i.e. basically what happened this time last year, we are going to see inflation tick up. We are expecting a fuel price cut come the beginning of next month of about 55 to 60 cents per litre. But even after putting that into our model, we still expect inflation in January is going to be a bit above 4%, which makes it difficult for the SARB to cut aggressively. Now, bear in mind, by the next time the SARB meets in November, at that point, we would have seen potentially 2 cuts from the Fed, and that might allow for 1 cut from them. But after that, we're going to sit in a situation where inflation is going to be well above their target, and we'll probably have to wait for inflation to settle closer to 3% before we can get any further cuts. So don't expect too much on the interest rate front from the SARB over the coming few months until we see inflation settle at a lower level. And that's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that are referenced in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.